If you're reading this on Monday morning, February 9th, 2026, you need to understand that what just happened in the silver market over the past 72 hours is not just another price swing, not just another margin adjustment, not just another regulatory tweak by the Chicago Mercantile Exchange. What you witnessed is the systematic dismantling of the largest concentrated speculative position in commodity market history, executed with surgical precision by the very institutions that created the problem in the first place, and the fallout from this event is going to reverberate through the precious metals markets for months, possibly years, changing the way silver trades, changing the way options are priced, changing the fundamental relationship between the paper market and the physical market in ways that most traders won't fully understand until it's too late to protect themselves. This is the story of how 200,000 call option contracts at the $80 strike price, representing 1 billion ounces of notional silver exposure, created a gamma bomb that nearly detonated the entire commodities exchange system, how the CME intervened at the last possible moment by raising margin requirements to 18%, forcing leveraged speculators into mass liquidation, how the price that was threatening to break through $80 and trigger an unstoppable cascade toward $110 or higher instead reversed violently, plunging from $79.85 to $71.20 in less than 6 hours of trading, wiping out billions in call option value, destroying the dreams of retail traders who thought they were about to ride the greatest squeeze in silver market history, and enriching the very banks and market makers who were short gamma and desperately needed a way out of their impossible hedging situation. The mainstream financial media is calling this a healthy correction, a return to normal volatility, a justified response to excessive speculation. But those of us who were watching the order flow in real time, who saw the sequence of events unfold minute by minute, who understand the gamma mechanics and the forced liquidation dynamics, we know the truth. And the truth is that what happened on Friday, February 6th was not a market correction, it was a market manipulation, a coordinated intervention by the exchange, the clearinghouses, and the bullion banks to prevent a liquidity crisis that would have bankrupted multiple major financial institutions and potentially triggered a systemic failure in the derivatives market. The bomb was real, the fuse was lit, the countdown was ticking toward detonation, and at exactly 11:47 a.m. Eastern Time on Friday morning, with silver trading at $79.85, just 15 cents away from the $80 trigger point, just seconds away from the moment when Delta would spike and market makers would be forced to buy 350 million ounces of silver futures in a cascading gamma squeeze that would have sent the price vertical, the CME issued an emergency announcement that changed everything, and that announcement said that effective immediately, margin requirements for silver futures contracts would be increased from 12.5% to 18%, representing a 44% increase in the amount of capital required to hold a leveraged position, and furthermore that this margin increase would be applied retroactively to existing positions, meaning that every trader, every hedge fund, every algorithmic system that was long silver futures would immediately be required to post additional collateral or face forced liquidation by their broker. The timing of this announcement was not accidental, it was not a coincidence, it was not a routine risk management adjustment, it was a precision strike designed to detonate the gamma bomb in reverse, to force selling pressure into the market at the exact moment when buying pressure was about to overwhelm the system, and the result was catastrophic for anyone on the wrong side of the trade. Within minutes of the margin announcement, the sell orders started flooding in. First from the algorithmic trading systems that detected the margin increase and automatically began reducing exposure to stay within risk limits, then from the retail brokers who issued margin calls to undercapitalized accounts and began liquidating positions when clients couldn't post additional funds, then from the hedge funds who realized that holding their long positions through the weekend with elevated margin requirements would consume too much capital and destroy their risk-adjusted returns, and finally from the momentum traders and technical systems that saw the price breaking below key support levels and interpreted it as a trend reversal, adding more selling pressure to an already collapsing market. The cascade was brutal, mechanical, unstoppable, the exact mirror image of the gamma squeeze that had been building for weeks, except now instead of forced buying driving the price higher, it was forced selling driving the price lower, and there was no natural buyer to absorb the wave of liquidation because everyone who might have stepped in to catch the falling knife knew that the margin requirements made it prohibitively expensive to hold a speculative long position, and the physical buyers who might have seen the lower prices as an opportunity to accumulate metal were paralyzed by uncertainty, unsure whether this was a temporary dip or the beginning of a much larger correction, unsure whether the dealers would honor the lower paper price or maintain their premiums at the elevated levels from earlier in the week, unsure whether the entire premise of the gamma squeeze had been invalidated by the CME's intervention or whether this was just a temporary setback before the real move higher began. The price fell from $79.85 to $77.40 in the first 30 minutes, losing $2.45 per ounce, then stabilized briefly as some bargain hunters tried to buy the dip, but the selling resumed at 12:30 p.m. when another wave of margin calls hit the market and the price dropped through $75, triggering stop-loss orders that had been placed by traders who thought $75 was a safe support level. And once those stops were triggered, the algorithms detected the momentum shift and accelerated the selling, pushing the price down to $73.50 by 1 p.m. And at that point, with less than 30 minutes until options expiration, it became clear to everyone watching that the $80 call options were going to expire worthless, that the 200,000 contracts representing 1 billion ounces of notional exposure were going to evaporate into nothing, that the market makers who had sold those calls were going to keep 100% of the premium they collected, and that the retail traders and speculative funds who bought those calls, believing they were about to profit from the squeeze of the century, were going to lose everything. The final print at options expiration was $71.20, a full $8.65 below the morning high, representing an 11% intraday decline, one of the largest single-day drops in silver price history, and the financial carnage was immense. Retail traders who bought $80 call options for $120 per ounce earlier in the week, paying $6,000 per contract for what they thought was a lottery ticket to a massive payday, watched those options expire worthless, losing 100% of their investment in a matter of hours. Hedge funds that were long silver futures with leverage found themselves facing margin calls they couldn't meet, forced to liquidate positions at the worst possible prices, booking losses that in some cases exceeded their annual returns. Algorithmic trading systems that were programmed to follow momentum and chase gamma experienced catastrophic drawdowns, with some funds reportedly losing 30% or more of their capital in a single day. The bullion banks and market makers, on the other hand, the institutions that were short the $80 calls and desperately needed the price to stay below that level, they made a fortune, not just from the option premiums they collected, but from the short positions they accumulated during the collapse, buying back futures at $72 that they had sold at $78 earlier in the week, capturing $6 per ounce on positions that represented tens of millions of ounces. The CME's margin increase was framed as a prudent risk management decision, a necessary step to ensure the stability and integrity of the market, but anyone with even a basic understanding of game theory and market mechanics could see what really happened, which is that the exchange intervened to protect its clearing members, the big banks and financial institutions that clear trades through the CME and would have faced catastrophic losses if the gamma squeeze had been allowed to proceed, and by raising margins at the exact moment when the squeeze was about to trigger, the CME effectively pulled the rug out from under the speculative longs, forcing them to liquidate not because their thesis was wrong, not because the fundamentals had changed, not because silver was overvalued, but simply because they didn't have enough capital to meet the new margin requirements. And this is the part that should terrify anyone who trades commodity futures, because it exposes the fundamental truth that the exchange is not a neutral arbiter, it is not a fair playing field, it is an institution that will change the rules mid-game to protect its members, and if you are on the wrong side of that intervention, there is nothing you can do, no appeal you can file, no recourse you can seek, you simply get liquidated, you lose your money, and the system moves on. The physical silver market, which had been showing signs of tightness and dislocation throughout the week, responded to the paper market collapse with confusion and fragmentation, because while the futures price was plunging from $79 to $71, the physical dealers were not dropping their prices anywhere near that much, and this created a divergence that confirmed what many of us have been saying for years, which is that the paper price and the physical price are two different things, connected by arbitrage mechanisms that only function properly when the market is calm and liquid, but when the market dislocates, when there's forced liquidation, when margins are hiked and volatility explodes, that arbitrage breaks down, and you end up with a situation where the COMEX futures price says $71, but if you call a bullion dealer and try to buy physical silver, they're quoting you $78 or $80, and the premium that was $2 over spot at the beginning of the week is now $7 or $9 over spot. and the delivery times that were 2 to 3 weeks are now 6 to 8 weeks, and some dealers have stopped quoting prices altogether, instead putting customers on waiting lists and saying they'll confirm pricing when metal becomes available. This is not how a functioning market is supposed to operate. This is how a broken market operates. This is what happens when the paper price discovery mechanism becomes detached from the physical reality of supply and demand. And the most disturbing part is that the CME and the regulatory authorities seem perfectly comfortable with this situation, perfectly willing to let the futures market trade at a massive discount to the physical market as long as it prevents a systemic crisis among their clearing members. The Chinese buyers, who had been accumulating physical silver aggressively in the weeks leading up to the squeeze attempt, they were the winners in this situation because they bought physical metal at prices between $72 and $78 throughout the week, securing supply at what will likely look like bargain prices 6 months from now, while the Western speculators who were playing the gamma squeeze in the paper market got absolutely destroyed. The Shanghai Futures Exchange, which had been trading at a premium to COMEX throughout the week, that premium widened to $4.50 per ounce by Friday afternoon, indicating that Chinese buyers were willing to pay significantly above the collapsed COMEX price to secure physical delivery, and this tells you everything you need to know about who understands the real value of silver and who was just gambling on derivatives. The geopolitical implications of this event are profound, because what just happened demonstrates that the United States financial system, operating through the CME and the major banks, is willing to intervene in commodity markets to prevent price spikes that would benefit foreign buyers and harm domestic financial institutions, and this sends a clear signal to countries like China that if they want to secure strategic commodities like silver, they need to buy physical and take delivery. They cannot trust the paper market. They cannot rely on futures contracts because the rules can and will be changed to prevent them from profiting, and this accelerates the de-dollarization trend, the move away from Western financial infrastructure, the development of alternative trading venues and clearing systems that are not subject to CME manipulation. The immediate aftermath of Friday's collapse was chaos, with margin calls continuing to ripple through the system over the weekend, brokers scrambling to calculate their exposure, clients trying to figure out whether to post additional margin or close out positions entirely, and a general sense of fear and uncertainty about what comes next, because the fundamental factors that were driving silver higher, the industrial demand, the investment demand, the supply constraints, those factors haven't changed. The only thing that changed was the CME's margin requirement, which is a temporary administrative tool, not a permanent fundamental factor. And so the question everyone is asking now is whether this was a genuine reset of the market that will lead to a prolonged correction, or whether this was just a violent shakeout that will be followed by an even more aggressive rally once the weak hands have been flushed out and the market stabilizes. The technical damage is significant, with silver breaking below key support levels that had held for weeks, triggering algorithmic sell signals that could keep pressure on the price for days or weeks. But the fundamental case for higher silver prices remains intact, and in fact, the forced liquidation may have created a better entry point for patient buyers who understand that the paper market is manipulated and the real opportunity is in physical metal held outside the banking system. The options market has been completely reset, with implied volatility spiking to levels not seen since March 2020, making it prohibitively expensive to buy call options for the next several months, which means the gamma squeeze dynamics that were building over the past 6 weeks have been eliminated, at least temporarily, and market makers can breathe easier knowing that they're not sitting on massive short gamma positions that could explode at any moment. The regulatory response to this event will be fascinating to watch because on one hand, the CME will argue that raising margins was necessary to protect market integrity and prevent a disorderly squeeze that could have damaged the clearing system, but on the other hand, there are going to be congressional inquiries, lawsuits from traders who lost money, allegations of market manipulation and insider trading, questions about whether the CME coordinated with the bullion banks to time the margin increase for maximum impact, and potentially even criminal investigations if evidence emerges that specific individuals had advanced knowledge of the margin hike and positioned themselves to profit from it. The retail trading community, particularly on forums like Reddit and Twitter where the silver squeeze movement had been gaining momentum, is absolutely furious, feeling that they were cheated, that the game was rigged, that just when their thesis was about to be proven correct, the powers that be changed the rules to prevent them from winning. And this anger is justified because that is exactly what happened. But the unfortunate reality is that anger doesn't change the outcome. Losses are losses, liquidation is liquidation, and the system has no obligation to be fair, only to survive. And if survival requires crushing the speculators to save the banks, that's what will happen every single time. The lesson here is not that silver is a bad investment, not that the squeeze thesis was wrong, not that you should give up on precious metals. The lesson is that if you're going to play in leveraged derivatives markets, you need to understand that you're playing in a rigged casino where the house can change the rules whenever it's losing, and the only way to truly own silver, to truly benefit from the long-term supply-demand dynamics, is to buy physical metal, take delivery, store it securely outside the banking system, and hold it as insurance against the exact kind of financial system manipulation that we just witnessed. The price of silver as of Monday morning, February 9th, is trading around $73.40 in early Asian session activity, up slightly from Friday's close as some bargain hunters return to the market. But the sentiment is fragile, the trust is broken, the memory of Friday's violence is fresh, and it's going to take time before confidence returns and the market can make another serious attempt at breaking through the resistance levels that triggered the CME's intervention. The physical premiums remain elevated, confirming that the demand for real metal hasn't disappeared. It's just that the paper market has been temporarily suppressed, creating a two-tier pricing system that will persist until either the paper market rallies to close the gap or the physical market experiences enough selling pressure to bring premiums back down. And my assessment is that it's far more likely the paper market will rally than the physical market will collapse, because the industrial users, the solar panel manufacturers, the electronics companies, the defense contractors, they need silver. They have to buy it regardless of price. And the investment demand from countries like China and India isn't going to disappear just because the COMEX had a margin-induced flash crash. This Monday morning, as the markets open and traders around the world assess the damage and try to figure out their next move, the one certainty is that the silver market has been fundamentally changed by the events of the past 72 hours, not in its long-term trajectory, which still points higher based on supply-demand fundamentals, but in the awareness among market participants that the paper market is a dangerous place to play, that leverage is a weapon that can be used against you, that the exchange will protect its members at your expense, and that if you want true exposure to silver, if you want to benefit from the coming supply crisis and the monetary debasement and the industrial demand surge, you need to buy physical, take delivery, and remove it from the system entirely, because as Friday proved beyond any doubt, the system is not your friend, the exchange is not neutral, and when the squeeze comes, and it will come eventually because the fundamentals demand it, the authorities will do everything in their power to prevent it from succeeding, and the only people who will profit are those who saw it coming, positioned themselves correctly in physical metal, and had the patience and discipline to hold through the manipulation and wait for the moment when the paper market finally breaks completely, and the physical price becomes the only price that matters. And that day is coming. Friday's intervention didn't prevent it. It only delayed it. And when it arrives, the divergence between paper and physical will be so extreme that historians will look back at this moment, this Monday morning in February 2026, as the beginning of the end of the paper-silver market and the dawn of a new era where real metal, held outside the system, becomes the only reliable store of value in a world where the rules can change at any moment to serve the interests of the powerful at the expense of everyone else.